And gentlemen, to the Mines and Money pitch battle. My name is Jochen Staiger. I'm the chief editor and founder of Commodity TV and also the CEO and founder of Swiss Resource Capital. You might wonder why I do the introduction here today on behalf of Mines and Money. There was a technical issue, so let me do that on behalf of Andrew Thake from Mines and Money. Very warm welcome here, from Switzerland and London. We are very happy that we can do that again. As you know, the pitch battle is something where we have, like today, 5 companies which want to present for 3 minutes each other, and then we will have with 7 minutes a Q&A, and at the end we want to see where $1 million, unfortunately, $1 million virtual dollars go to which company. And I urge also already the judges, you can split it in half, but please not more, because otherwise it will be mathematically a big issue. And we look forward to that. And it is like, Dragons Den, or it's like Höhle der Löwen, as we say it in German, but we are much more polite, I can assure you. And let me first introduce our judges here. We have Professor Dr. Torsten Dennin, the CIO of Asset Management Switzerland. Torsten, welcome. Good to see you again. And then we have Finn Behnken, the Senior Representative Africa from Auramet. Hi, Finn, good to see you. Karr McCurdy, partner of Rock Elm Capital. Hello, Karr.
Good morning.
And good morning. Nicholas Sarro-Waite, analyst at Lascaux Advisors. Hope I said that correct. Hi. And Simon Popple, managing director of Brookville Capital. Hi, Simon. But also we have 5 fantastic contestants, and I just want to tell you whom we have here. John Barker from Lanco Gold, Kyla Hardy from Cloudbreak Discovery, Jay Kumloskas, I hope I said it also correct, from Camino, and Mark Jarvis from Giga Metals, and Philippe Cloutier from Cartier Resources. I would suggest we go directly into it, and I have my lovely buzzer here to stop you if it's getting too long. And let's enjoy it. And we want to start with John Barker, the Vice President Business Development of Lanco Gold. So John, the floor is yours.
Many thanks. Well, the Loncor story is only just emerging for many, and yet we're months away from illustrating the potential of a company changing high quality gold ore body. And that's namely the Dumby body, which is illustrated there. This, what follows could be considered promotional, so please be aware of the cautionary notes. We need to tick a number of boxes to get attention as a junior: location, management, a quality ore body, and an obvious catalyst to release the value. And I think we tick all the boxes. On location, we're up in the northeast of the DRC. We control over 4.6 million ounces of gold resources there. Investors have been drawn to the DRC recently via Rob Friedland's success with Kamoa-Kakula copper project. But for us, we point to Barrick's Kibali joint venture.
John, really, sorry to interrupt you, but we don't see your slides. You're not sharing. Sorry for that.
All right.
You should share them.
Let's try again.
No worry, I give you the time extra.
Yeah, thank you.
Share screen it is.
Yeah, I'm gonna have to go out and come back out again. Screen, sorry. Let me just do that.
Okay, I noticed that Andrew put himself host a while ago, so that might be the reason.
Okay. Okay. All right, guys. Let me, because I was there a moment ago. Yeah. Now I'm struggling.
Can you share by yourself? Because if you go down to share screen, that should work.
Try here. Okay, let me get back to it here.
Yep, that looks good. Okay.
One moment. I just want to. Can you still see the full screen now?
It's perfect.
All right. You want me to start again, guys?
Yes, please, please do that. Because we have to be fair.
Sure. Thanks, guys. So many thanks. So we're just emerging. Like I said, really, we're really months away from the potential of a company-changing, high-quality gold ore body, and that's the Dumby deposit that is in the picture. And it is a promotional a few slides, so please be aware. Getting to the heart of it, I said we needed to tick a number of boxes: location, management, quality ore body, and the some sort of catalyst to release value. But we tick all those boxes. We're up there in the northeast of the DRC, and we control over 4.6 million ounces of gold resources. But the DRC really has attracted investors of late through the Ivanhoe mining success of the Kamoa-Kakula copper project. But for us, it's the Barrick's-Kibali joint venture, regularly rated within the top 5 of global gold producers. It's sitting where the red zero is in Loncor's ground there, 220 kilometers away from us. It's got over a decade of output behind it and regularly exceeds expectations. It's Barrick's lowest cost African operator, and interestingly, Kibali, the mine, has grades similar to our own Adumbi deposit and proves what can be achieved in our jurisdiction. So it's a team effort. This is another view of our Adumbi project. The team built it. Our CEO, Arnie Conrad, has over 25 years experience in the DRC. Our president, Peter Cowley, is a geologist, has found over 30 million ounces in the prolific banded ironstone greenstone environment that spreads across the DRC and Tanzania. Looking at the geology, Adumbi had just over 1 million ounces of resources 2 years ago. And after we reassessed previous drilling and did our own infill and extension drilling, we pushed the in-pit resource 3.15 million ounces at an excellent grade. Adding another 2 deposits close by, and it moves it up to close to 3.5 million ounces. Critically, Adumbi illustrates, as I mentioned, an in-pit grade similar to Kibali. We're drilling deeper and hope to move the resource ounces in the table closer to 5 million ounces by year end at tier 1 classification. So what will be the catalyst to kickstart Loncor? Step 1, by the end of this year, we should have an economic value announced from our ongoing open pit PEA being conducted by DRA. And given the quality, we believe the Loncor's 84.68% of the NPV could be many multiples higher than our current market cap of 73 million. Step 2, we're looking to drill at least 2 more holes to create an underground resource targeting over 1 million ounces by year end. So this could take the Adumbi area close to the magical 5 million ounce resource. Note that's only down to 650 meters on this deposit. So looking at the key principles of an ore body, Mark Bristow's commentary, we have revenue in situ. It sits around 5.6 billion in the open pit resource with the underground to follow. We have quality, it's as good a grade, if not better than Kibali nearby, so hopefully lower cost operation. And we have time associated with the release of value. 4 months from now, we should have an assessment of the value. And we believe Loncor represents a cheap option at 73 million US dollars. And that's it, thank you.
Thank you very much, perfect. Please stop the sharing that we get back to the...
Yep.
Yes, perfect. Yeah, thank you very much. And questions, please raise your hand. Who wants to ask the first question? Simon?
Yeah, just a quick question.
Hi, Simon.
Hi there. DRC has got a good reputation in terms of ESG. What's the kind of, is there a company policy on ESG at all?
Look, obviously for us as a junior company, we've been developing ESG. We've been doing things on the ground. We've been there for a number of years now. So we built clinics, we built a school there, and we're also helping to improve the water quality. But as going forward, I was talking to a group yesterday, Digby, about a larger, more holistic approach for us going forward, because obviously that's something we need to look at going forward. So it's in a development stage, like our company, I think, currently.
Okay, thanks very much.
Then I think Niklas, have you raised? Sorry, then Finn. Finn?
Yeah, sure. John, thanks very much. Just quickly, you want to touch a little bit about on the logistics? I mean, Congo is a very difficult place to operate in. You've seen companies like Alphaman having to chop their own roads, and very difficult to get material, men and equipment in and out. Maybe you could just touch a bit on that.
Yeah, I mean, from my perspective, I've been around a long time and I've seen these early stage exploration areas develop. When I first went to Tanzania, it took me a day to get from Mwanza to Geita. So that's what happens in early exploration, and we're no different. We're in a place that needs infrastructure. We are busy just finishing a significant runway currently, which will help certainly with getting logistics in and getting things such as core out into Mwanza and Tanzania for testing. But it is something, again, work in progress. The obvious thing would be to improve the road structure from Kibali, which obviously has most of the infrastructure we would need. It has obviously equipment gets fixed up there, and it gets the equipment for the plant. Everything's at Kibali. So if we put a road up there, 200 kilometers, I think that would solve a number of our issues. But again, it's work in progress. We are early stage. It is fairly tough to get from A to B in this area, but things are improving.
Torsten?
Yeah. Thank you, John, for the update on this interesting option. Can you give me like the perception from the investor side? Investors are focusing always of what can go wrong. What is your key sensitivity from your perspective? What can go wrong in your story besides the drilling results?
Look, we're looking at metallurgy. We already have some met results, and the indications are it's 90 to 95%. But we've got another 4 or 5 holes down in South Africa being assessed to feed into the PEA. That's obviously a critical thing, but touch wood, that should all go to plan. Things like capex may be higher than we think. There's always potential blowouts, but we don't see anything. I mean, if you look through the issues, power, we're going to have power either from gensets or hydro in the way that Kibali is. One will be more expensive than the other, but one will be cheaper than the other. So these are things that we're looking at within our particular project. Of the other things, we're very happy about the way the government's developing. And I think that Tshisekedi has actually consolidated his position in the country. I think the Americans are paying more concern in the DRC now, and I think are also very supportive about the way the government is. So we're happy about the way that's going. And I know we are certainly very supported by the government. So so far so good in this stage. I mean, as I say, we're early stage, and for many, there's a lot of hurdles to pass. We essentially have a mining license already, so that's not so much an issue. We have what's called an exploitation license currently, so that allows us to carry all the way through. Yeah, so unless you can think of something, I'm struggling a little bit. I apologize.
Good to see. Thank you.
Yeah.
Then Finn again.
Sorry, John, another question is, when Kibali was developed, what were their ore resources looking like? You know, how many ounces warranted that investment by Barrick or Randgold at that stage?
Look, that was way back about 12 years ago with Randgold. I would have to review those figures, but it was close to double figures resources at that time. Don't quote me on it. I'm not 100% sure on that figure. Just remember too with Kibali, I mean, this is a world-class mine, had EBITDA of around $900 million last year. It's churning out cash, this operation. But about 55% of the production is now underground. So there's only 45% open pit. In the early days, it was all open pit. And I'd suggest they had even lower costs than they have now. And, you know, that's just something to bear in mind when we talk about Kibali. But as far as that resource in the early days, I'd have to go back and look at the DRA feasibility study to gauge that. So apologies.
Yes, Nicholas?
I know you're working on your PEA, but could you just give us some dimensions for capital and throughput so we understand the scale of things that you're thinking?
Yeah, so let's start at the top. Historically, we've always discussed an 8-to-1 strip ratio for this project. Obviously, that'll be refined. Given the shape of the topography, we'd hope it's less in the first few years, which is great for cash. I mentioned, let's say 90% for met, depending on what comes out in these recent figures. CapEx, let's choose a figure of 400 million to be sort of on the conservative side. It doesn't need to be the biggest plant because of the grade. The tonnage is not so good, but you know, there may be issues because of the location as well. So if we choose a 400 million, and on the cost side, I think if you were again to be conservative, looking around at $800 million all-in cost per ounce, which is similar to what Kibali is, even though a lot of their production is underground, it would be a nice conservative figure for you to start off. And using those metrics, I think you'll find you come out with fairly significant NPV. Production wouldn't be for realistically 3 or 4 years. So you're going to have a delay, and it depends on your discount rate. But if you were to choose spot price in those, you'll find we get a very significant NPV dropping out of that.
What would your annual production be in gold ounces, just roughly?
We're looking around 300,000 ounces.
So
maybe nuance.
More than 10,000 ton per day mill.
Yeah. Yeah, something around those levels.
Thank you.
Okay, just to clarify, $800 AISC, not 800 million.
$800 per ounce.
Was not the CapEx.
$800 per ounce, all-in costs. Yeah.
Super. Great. Thank you very much. Those were the
Thanks.
7 minutes. Thanks to you, John, and thanks to the judges. And now we would like to move on with our next company, and it's Kyler Hardy, President and CEO of Cloudbreak Discovery. Kyler, I would say the floor is yours. Do you have also slides?
I do here. Just let me bring that up.
Yeah, please share that. Thank you. Okay,
How does that
then
work?
let's get started.
Brilliant. Thanks very much for having me here today. So Cloudbreak Discovery is a new listing on the LSE standard segment, and recently listed in June of this year. But so we're a project generator and royalty business. It is a new listing, but it's not a new business for us. We've been executing this business for over 10 years privately, and decided to bring a number of our companies together to form Cloudbreak. It's the company was originally founded in 2015 in the energy space, but you know, not everything goes as planned. So we reworked our business plan and built a mining resource generator now. So with all that being said, we look to diversify our project and jurisdiction risk. Unlike many of the other companies on the call here today, we take a multi-project approach and attract partners in order to advance those assets that we acquire through staking and acquire through property deals with prospectors. So as we take the project from a concept and then into the staking phase, we'll execute a phase 1 exploration program on it, and if that proves out, great. If not, does it show a different thesis? And from there, we if it does show a different thesis, we plan phase 2, which is pretty typical, and bring a partner in to advance it from there. So when we bring a partner in, it's either via a joint venture, option, sale, or the third methodology that we use is a plan of arrangement or a spin out. And historically, this has proved quite fruitful for us and our investors. And we take a cash, equity, and royalty component in those companies that we partner with to maintain that discovery upside and that development upside. So with that said, it's this business plan is very much focused on management's ability to execute, and we've got multiple pillars in our business. Our corporate team has a lot of transactional experience, while our geological team is very adept at finding new ideas and focusing in on jurisdictions. We're currently active in North America, and getting more active in West Africa right now. We have 15 projects, 8 of which are being advanced by partners, and over 5 million of exploration funded by our partners is occurring this year. So with that said, I'm open to some questions.
Wow, that was exactly on the second. Fantastic. Thank you very much. And yeah, questions please now from our judges for the next 7 minutes.
Kyler, I'm just curious, of the 8 royalty holdings you have, are any of these generating any cash at present?
At present, no. There's 2 royalties, one of which is a silica and alumina silicate quarry in development right now. We should be seeing cash flow off that late this year to mid next year. It's a private company that's developing it, and it's currently building its customer base. And the second more advanced royalty is on the La Blanche asset, a TiO2 titanium vanadium asset in Quebec, being advanced by Temas Resources. And they're currently undertaking a PEA and metallurgy on that asset, where we own a 2.5% royalty. And I mean, we don't anticipate revenue off that anytime soon, but they are advancing it through the advanced studies right now.
Thank you.
I think Simon, sorry.
Yeah, just a quick question. You've got 15 projects, and I think you said you had 8 in royalties. how many have you got sort of optioned out? Are all 15 optioned out, or is it a number between the 15 and 8 that are optioned?
Great question. So there's 8 properties optioned out of the 15, and of those, there's 8 royalties on those projects. Of the remaining projects, we've been very active over the summer. We staked a number of those projects during the summer. We call it the Northwest portfolio in British Columbia here, up north. I guess that would be the northwest area of the province, around Atlin, northwest of Dease Lake, into that far west side of the province. And we're just about to undertake a short exploration program across those assets, and off the back of that, we'd anticipate moving most of those assets on to third parties. We've been in discussions on them. They'd like to see some results before that. And the last one, which is in Ontario, the South Timmins project, we're in advanced negotiations to partner with a junior on that as well.
Okay, thanks.
Then Torsten, please.
Karr, thank you for introduction. First time I see the story. Do you rely with 15 projects on internal or external management skill? Maybe first part of the question. Second is 15 projects, how do you manage to move them all forward to their potential?
Great. So we've got a full internal team. It's managed so corporately, myself, we've got a CFO, of course, and two head geologists, COO Rory Kutalulu out of Vancouver here, and Cam Barsh out of off Vancouver Island, manage our technical teams. For field operations, we generally contract that out due to the cost of having staff right now is slightly prohibitive. And the second part of the question being, how do we advance all 15? We rely on our partners to advance them. If we have a large equity stake in those partners, we'll put a director, maybe 2 directors on with them to help advise and give our operational knowledge of a region. But it's primarily on our optionee or joint venture partners to move them forward. We do put milestone and work payments, or sorry, work commitments in per year for a 3 to 4 year period for them to hit those milestones.
Finn?
Tyler, thanks. What is your market cap at the moment, and how much cash do you have in your balance sheet, and what's your kind of burn rate, given that most of your partners are developing the project?
Great. So our market cap is currently approximately £8 million, and our cash position is about 1.2 million. Additionally, on top of that, I'm just going to slip over to Canadian dollars here for a minute. We got to have about 6.3, 6.4 million of listed securities that are liquid on our balance sheet right now as well. That portfolio has been beat up over the summer. I think we've all seen the market malaise kind of hit various pieces of us, but it's our goal is to have this as a self-perpetuating model without having to go back to the market too often for additional capital. We do rely on moving those projects, on eventually exiting those positions once there is a discovery or a major milestone, and using that to restake new projects. With that being said, our burn rate is pound sterling, about 90K a month right now, around that.
Okay, thanks.
Questions? Okay, then I have a question. Any countries you will not touch, or let's say, do you have a special focus on continents?
Thanks for that. That's great. So we're currently focused on North America, but one of the reasons we came to the LSE and listed over there rather than in Canada is we are cycling part of our portfolio into West Africa. We think that there's a great opportunity there. We've spent a lot of time operating there historically, and the Canadian markets don't. I find it's a lot tougher to get traction for this type of a story in Canada. That's hence the reason we came to London. we're not particularly focused anywhere in South America currently. We just not enough bandwidth, and we don't touch Central Asia. It's just it's too complex, and the political climate isn't something that we think we can deal with. But West Africa, North America, no problem, and we are looking at ideas in the Philippines as well, due to some of our people on the ground.
Okay, super. Thank you very much, and that's the 7 minutes. Thanks, guys. Perfect. So now we have to move on to Mark Jarvis, the CEO from Giga Metals, because we couldn't find the other company. Yeah, Mark, are you there, or Holly? I don't hear anything.
I'm here. I just unmuted.
Super. Okay, then please let's get started. Hi, Mark.
Hi, how are you doing? Welcome.
Good, good. Perfect.
Good. Good. So Giga Metals is, we've got a core asset, which is an extremely large nickel and cobalt deposit in sulfides, low grade, open pitable, located in northern BC. We've recently completed a PEA that models nameplate capacity of 37,000 tons per year of nickel in a very nice concentrate. This is an extremely large deposit and an extremely large project. We're looking at a 37-year mine life. Now, like most of the large undeveloped nickel deposits of the world, our project is sub-economic or marginal at the low end of nickel prices. And so we do represent a lot of leverage. And nickel has been edging higher, and the reason is, and we think it's going to be quite volatile to the upside in the coming years, is the electric vehicle revolution. It's a key element in batteries. It's the part of the cathode that stores the electrons. So if you want your car to go farther on a single charge, you need more percentage of nickel in the cathode. And this is leading to an uptick in demand. Bottom line is you need 40 to 70 new large nickel mines by 2040 just to feed demand from the electric vehicle business. So, of the known large deposits of the world, all of them need higher prices to get developed. So the thesis is we're on the cusp of higher prices in nickel. Our location in north central British Columbia, we're in a good jurisdiction in terms of ESG practices. We've got access to a year-round deepwater port at Stewart. Canada is an excellent jurisdiction if you're concerned about ethical supply chains, and people in the electric vehicle business generally are, particularly in Europe and to a lesser degree in North America. So again, our project is very large, low grade, but we get, for this type of deposit, we get excellent recoveries to a high grade concentrate, and our flow sheet is simplicity itself. Crush it, grind it, float it. Next slide. I'll just speak to this briefly. Next slide. I don't have time for this. Most of our competition are what are known as HPAL projects, and HPAL projects have worse economics than ours. They are getting built by the Chinese mostly. So they are, they're building these HPAL projects with internal rates of return of 1%, 2%. And I guess I'm out of time.
Voila, here we are. Thank you very much, Mike. Now, please, our judges with questions. Who wants to start? Yeah, Simon, please.
Can you tell me what the CapEx is, please, to get it into production?
Stage one is 1.4 billion, which takes care of a lot of infrastructure costs. And then stage two, where we double production in year 5 or 6, depending on conditions, is $500 million. And this is all US dollars.
Sorry, what's the payback in terms of years for that, the 1.4?
Oh, well, at 750 a pound, which is what we ran our base case at, it would be something on the order of 15 years. Nickel is just under $9 a pound right now. And the long-term average nickel price in 2020 dollars over the last 40 years is $11 a pound US.
Okay, thank you.
Next question. Yes, Finn, please.
Mark, what is your market cap and time to production? I mean, all things being equal, when would you see yourself putting this into production, this project?
Our market cap is about 30 million US or 30 million Canadian dollars. We can be in production by 2028. We're currently gathering the data to perform a pre-feasibility and then to go to full feasibility, including permits. The environmental study will take about 3 years.
And do you think you'll partner with somebody, or are you investigating partnering with the major in order to put this together?
We're talking to a lot of potential strategic investors right now. Our president is a fellow named Martin Vidra, who had a 30-year career at Sherritt. He's an engineer who used to run their refinery at Fort Saskatchewan in Alberta, but he also spent a good part of his career selling nickel and cobalt products to end users. So they all know him, he knows them. And we're finding a lot of interest right now. The Chinese are killing it in terms of the battery business and the electric vehicle business because they own supply. They own cobalt in the Congo, cobalt production in the Congo. They own a lot of copper production, and they've been building these sub-economic HPEL projects in Indonesia and Papua New Guinea because that locks in a nice long-term supply at a known cost. So the Western companies are starting to wake up that if they're going to compete with the Chinese, they need to do something similar. And we're finding that, particularly in the last couple of months, they are phoning us. And I'm talking about battery companies, very large car companies. So we're very interested in investment at the project level rather than at the equity level. And I think we're getting traction. So
Mark,
stay tuned.
Mark, what are your plans for marketing the concentrate? What are your thoughts on that?
Well, what we modeled is selling to a smelter simply because that's a market that exists. What we're looking at doing is processing that further to mixed hydroxide precipitates, which is emerging as the form of nickel and cobalt of choice for battery manufacturers. You can't, it's just flying off the shelves in that form. And the payabilities are extremely high, 85% plus. In fact, currently better than 90% payabilities for nickel in that form. So that involves one more step of processing beyond the concentrate. It's a simple pressure oxidation circuit. It's the easy part of hydrometallurgy. Once your metals are in solution, the rest is relatively easy. It's getting them into solution that is the difficult part. So that's what we're looking at right now, and we're modeling that and doing a lot of test work around that. We think it will increase our economic value.
Yeah, Mark, we know that ferro-nickel production in particular is pretty carbon intensive, if you will. I note that you tout your carbon footprint as being a bit on the novel side of the spectrum, low. Could you just comment on that?
Sure. Well, what we modeled in the PEA using a diesel fleet is 2.4 tons of CO2 equivalent per ton of nickel. If you could use an electric fleet, that would get it under 1 ton per ton. And we've been supporting research at the University of British Columbia into CO2 sequestration in our silicate tailings. And it's significant. We're working with Professor Greg Dipple at UBC, who's been studying this for more than 16 years. Mount Keith in Australia, diabit mines in the Northwest Territories. When you grind silicate rocks up fine and spread them in beaches, they absorb CO2 at a ferocious rate. And we've modeled that. We think we've got a realistic chance to become a carbon neutral nickel mine, as opposed to if you were to take, as Qingshan has threatened to do, nickel pig iron and convert it to matte, you would be at about 60 tons of CO2 equivalent per ton of nickel produced. So, and there's other environmental considerations as well. These HPAL projects mow down tropical rainforests, you know, the ones in Indonesia and Papua New Guinea, not necessarily the dry laterites in Australia, but they mow down tropical rainforests and in many cases dump their tailings into the ocean. So, you know, in terms of ethical supply chain, we've got them beat that way. We've also got them beat economically, strangely enough. It's just the Chinese have a low cost of capital and they're building them despite the low internal rate of return.
One more question.
Right, thank you.
So then I have a question, if there's nothing from the audience here. You wrote 37 years production, 37,000 tons per year nickel, but also I saw in your presentation nickel and cobalt. So is that nickel equivalent? And if not, what is the nickel production? What might be a cobalt production? A short answer, please.
We make a concentrate that is 18% nickel and 1% cobalt. Mm-hmm. So we're not talking about nickel equivalent. We're talking 37,000 tons a year of nickel. With an 18-to-1 ratio nickel to cobalt.
Mm-hmm. Okay, super. Thank you very much. Those were the 7 minutes. Perfect.
Thank you.
Presentation. Thank you, Mike. And now we have Philippe Cloutier from Cartier Resources. You have also slides, Philippe, I think.
Yes, I do.
Please.
Can you see my screen?
Now it's coming. Yep, here we are. The floor is yours.
All right. Well, thank you. We are Cartier Resources. My name is Philippe Cloutier. We're listed on the TSXV, and I'm going to give you a very brief overview of the company. Cautionary statements, because I will be making forward-looking statements. We have $8.5 million Canadian in the bank, 218 million shares outstanding. But have a look at our share distribution. Corporate and institution, over 45% ownership, of which Agnico Eagle is a large shareholder. Management and board, about 4%, and long-term retail, 33%. So there's only about 18% out there floating around as unknown retail. We're located in the Quebec portion of the Abitibi Greenstone Belt in northeastern Canada. We have 4 projects, 4 deposits. Our flagship is the Chimo Mine project, where we recently tabled a 2 million ounce resource. You can see that there are mills and senior gold producers as our neighbors. So our flagship, the Chimo Mine project, when we took it on in 2013, we compiled it. Is a past production of about 400,000 ounces, and today with our work, 60,000 meters, we were able to table nearly 2 million ounces of resources indicated and inferred. You can see the backbone infrastructure in 1997. It did cease production, not for lack of ore, but because of very poor economics. And you could get a glimpse right here on the right-hand side of the slide of the level of advancement of our ongoing internal engineering studies. You could see the stope design and mine scheduling. And so you could imagine that our PEA chapters are firming up quite rapidly. Our 3 other deposits that are in the emerging Windfall Belt, the Benoit, we are currently drilling and almost wrapping that up. Fenton, we were successful in acquiring 100% of that deposit earlier on this year from the government. We found a partner to option the Wilson project too. So Benoit, Fenton, and Wilson are seeing rapid advancement. And so for this year in 2021, the catalyst will be a valuation or a price tag event via the PEA on the Chimo Mine project, and drill results from our Benoit and Wilson projects, and a brand new design for a new adventure or drill program on the Fenton project. So that's a very quick overview, and if you do have any questions, I'm free for them right now.
Fantastic. Thank you very much. 5 seconds before the time. Love it. Yeah, questions, please. Everybody's overwhelmed. Yes, please, Nicholas.
What was the historical production of the mine, of the Chimo, and grade specifically?
400,000 ounces of gold, There are 3 gold corridors. On the northern corridor, 15 grams per ton. In the central corridor, about 5 grams per ton. And in the southern corridor, about 5 or 6 grams per ton. Towards the end of the mine life, Cambior, the operator at the time, pushed the grade down to about 3.8. They stumbled onto bulk mining underground, believe it or not, as early as the 1990s, mid-1990s. There are 2 current examples along the highway, Goldex and Alamos with Young-Davidson, that are tackling bulk mining underground deposits. Our resources is 21 million tons at about 2.9 grams per ton.
Finn, please.
And how do you think you'll mine them, Philippe? What mining method are you going to use?
There's the bulk mining underground stope backfill, and we're looking preliminarily about evacuating about 6,000 tons per day from the shaft and or an additional ramp. As I mentioned, Goldex is doing that at over 1.5 kilometers underground, and they've got a cutoff grade of 0.9 and head grade of 1.5. Alamos has just recently developed their or finished building their lower mine. Their cutoff is 1.7 and their mine grade is 2.7. And so it's massive bulk mining underground. And fortunately for us, the project is situated right by the highway. So you could truck it to local mills, or you could even put it on a rail and then further your custom milling right into Ontario. Obviously, the base case PEA might involve building a mill, but there's a lot of alternatives.
And maybe you could just discuss a little bit about, a bit about the permitting requirements that you need to do to go through. I mean, this was an old mine. Is it easy to get the tailings and the met plant up and running and permitted, or do you need to follow the entire process again?
Well, if we're running it if we're running it through selling the project to a senior mining company, they have their own different accelerated hoops to jump through. So I won't even comment on that. But if you were to build it yourself, it's a relatively short timeline because there's no environmental liability currently on site because it was fully reclaimed. As long as you bond your money, you go through the process, and the permitting can be done within 2 to 3 years. Mm-hmm. But that does not preclude you from dewatering the shaft and doing an exploration pre-mining program.
Torsten?
Philippe, what is the timeline you're thinking of to get to the decision to either develop yourself or to sell it to a third party regarding flagship project?
We're right in the middle of that process, and it could be done as quick as before Christmas.
Simon?
What are your, do you have any idea on all-in sustaining costs, or if you don't, do you know what Goldex are currently incurring?
I do. We are, as I mentioned, we're running scenarios on building it ourselves and or selling it to current producers along the highway. And since they have various mill capacities, various mill circuits and types of processes, CIP, CIL, gravity flotation, we're running the various scenarios. I am not at liberty of telling you the all-in sustaining, the payback and all that, but we would not be continuing the work if we didn't see the light at the end of the tunnel.
Okay.
That's as much as I could say.
Finn?
Your current market cap at the moment?
About 55 million. Mm-hmm. Of the 8.5, there's $4.2 million that flow through.
Mm-hmm. What would be a possible production scenario in ounces per year? Just a rough guess. I know it's a forward-looking statement for the regulators, but just you must have an idea, I would say. And would that attract Agnico, as they are your largest shareholder, to really bite into your company fully?
They're our largest shareholder, but they don't have a first right of refusal. Uh-huh. We've mapped out things that look like 115 to 125,000 ounces per year. Mine lives of about 9 to 10, years. Obviously, the great advantage of this project is we have elected to stop all drilling from surface. And therefore, you may have guessed by looking at one of those slides that there's upside potential. You could create and continue to generate more ounces at depth and laterally, but that's not going to be done by us in that surface right now.
Could you imagine
How long
to
will it-
spin out that? Sorry, yes, please. Who is that? I didn't
So
say.
it was Finn. Sorry about that.
Please,
Sorry.
please. No, go on.
Jochen, to de-water, is a mine flooded at the moment? Can you get a drill rig in underground in order to start drilling from underground?
No, the shaft is flooded. It was flooded, and there was a concrete plate put over the top. There's a 25 kilovolt power line that comes within 300 meters of that shaft. The dewatering process can be done, can be accelerated, but obviously the limitations on that is once you dewater it, you have to have residence time of that water before it's allowed to flow back into nature. But indeed, that is one of the plans, is to try to get underground as fast as possible to take all your inferred and indicated and put it into measured and to start to pre-produce there. You're allowed to do that in Quebec as long as you're under 5,000 tons per day, and as long as you have initiated the process of full permitting. Windfall is an example. They're currently advancing the ramp while they're working on the full permitting.
Okay.
Super. Thank you very much. 5 seconds left. Great. Thank you very much. Great presentation and the Q&A. So now we are coming to the question of the question. To whom you want to give your $1 million? That's the key question here. I would like to start with Torsten.
Thank you, Jochen. Some interesting news stories for me in this panel. Looking at the different stories, I have some pre-adjustments about nickel because of the capital intensity. So therefore, don't take it personal. I'm out of the nickel development, also on the long term. Making it short, I would break up my million into two parts. First part goes to Cloudbreak Discovery, and second to Cartier. And I think here's a good mix in terms of very entrepreneurial development option plus very experienced and track record and solid story. So for me as a portfolio manager, I mean, this is a balanced strategy, a little bit developing the risk. Thank you.
Okay, thank you very much. Then Finn Behnken from Auramet, to whom you want to give your $1 million, please?
Cartier Resources. I like the fact of putting old mines back into production. You know, the permitting probably a little bit easier, infrastructure there, track record of assets in the area, gold production in the area, and you know, there's going to be a couple of hurdles. Are the ground conditions still good underground? But overall, you know, I think there's a lot of old mines that people walked away just too early, and putting them back into production makes a lot of sense. Jurisdiction makes a lot of sense. So Cartier.
Super, thank you. Karr McCurdy from Rock Elm Capital.
Yes, thanks, Jochen. I like Giga Metals. I think it's a strategic holding. You know, our firm, you know, looks for longer term opportunity associated with its, you know, earlier investment. And, you know, so I like the strategic position there. I think the business model complements the off-takers, the strategic off-takers that are present, and I think that's very important. So it's a very interesting development, and I like the way you're working to align the broader stakeholder priorities to bring together what would be a very capital-intensive, albeit long-dated strategic resource. Thank you.
Thank you. Then Nicholas Sarro-Waite from Lascaux Advisors.
First, compliment all of the presenters. They all have unique opportunities that should warrant investment in them. I'm with Karr on this one. I think the attractiveness of a strategic nickel sulfide deposit kind of is the trump card for a lot of investment dollars in mining going forward. There's different formats for that in different minerals, but in nickel, this is it. And I hope that the team does well developing it. And I agree with Karr that developing this downstream, it's sort of almost like an infrastructure play too. Battery metal production in North America, it's something that needs to get figured out, but I think that it will. And I think that's going to drive the value creation in Giga. So I would invest in Giga.
And so the full $1 million goes to Giga, just to make that clear. Thank you.
Yes.
Then Simon Popple from Brookville Capital, to whom you want to spend your $1 million. First, you have to unmute yourself. Simon, we cannot hear you.
I think Cartier. I like Giga, but I think the capex number is quite high, which is very common. But I think Cartier has got a better route to cash, which as an investor is something I like. So that's where my $1 million goes.
Good, full $1 million to Cartier Resources. Boy, that was quite close. So then we have a winner, and that's Philippe Cloutier from Cartier Resources. Congratulations, $2.5 million. And then Mark Jarvis is second with $2 million, and we have Kyler Hardy with $500,000. But please, don't feel bad about it. You all presented well. You have all great companies, I must say, and it is the perception of each investor. As we all know, we are all individuals, and we have our decision to make. And so Philippe, we see you in the final then, as I assume there will be a final quite soon here this week. In that sense, I have to say thank you very much to our judges, good questions, and also to our contestants with great presentations. Thank you all. And on behalf of Minds and Money Pitch Battle, I wish you all the best. Stay healthy. That's very important, and hope to see you soon. And maybe end of November, beginning of December, personally in London. And then we all should have a really big beer if that works together.
Thank you. Be safe, everyone.
Yeah, please stay healthy.